Should you be converting and spending your tax-deferred balances down to zero? This is a question that we receive a lot in our practice and is going to be the topic of today's video. Now, we have a library on our Safeguard Wealth Management YouTube channel all around Roth conversions, why they may or may not make sense in your situation, why there are certain tax hurdles that you will face throughout retirement that can raise your marginal rate and thus make taxes higher in retirement than maybe even the last couple of years that you were working. And so there are all of these reasons that Roth conversions make sense for many situations. It often begs the question for retirees, if some Roth conversion makes sense, does more Roth conversion make even more sense? Should I have the goal of spending my tax-deferred accounts down to zero? Now, the answer to this question, as with most things in retirement planning, is that it depends. Everyone watching this video is in a different financial situation, has a different tax situation. So in this video, I'm going to talk through the reasons why you may want to convert all of your tax-deferred accounts and why you may not want to convert all of your tax-deferred accounts, and talk through the break even between those two situations and who fits into each given category. Now, if you find value out of this video, the best thing that you can do is hit the like button down below, subscribe to our channel. That will help other retirees just like yourself find this video and hopefully get some value out of this video as well. So let's hit the ground running. Now, as with almost every video within our Roth conversion series, there is an underlying theme that I want to make sure everyone is taking away from each of these videos. And that's, you need a map to plan for taxes in retirement. The decisions that you make at the beginning of retirement will affect what your tax situation looks like in 2025, 2035, 2045, and even beyond. And so you can't procrastinate when it comes to tax planning. You need to know what your situation looks like at the beginning of retirement, or have estimates for what your situation looks like at the beginning of retirement, so you can make the right decisions throughout your retirement. I really urge everyone watching this video to equip themselves with what we call a forward-looking tax plan. A tax plan that lays out not only what your situation is going to look like for the next 5 years, but also estimations for what your tax planning situation looks like for the rest of your retirement, so you can make decisions on an ongoing basis. What I find most people do is they take a shoebox full of receipts into their CPA at the end of the year and they go, what can you save me? And that might work while you're in the accumulation phase, but once you enter retirement, this process no longer works. By this time, your CPA has a lot less tools and strategies that they can use to save on taxes, and so you need to be planning early on, okay, years ahead of time in order to save taxes down the road. And again, a forward-looking tax plan is the tool that you need to be equipped with to do so. And so on the screen right now, you see a chart that is included in a forward-looking tax plan. And as you can see, this person's situation, they're in some pretty low tax brackets early in retirement. Once they turn on Social Security and turn 72, RMDs begin, and they see themselves pushed into much higher brackets. And so this is the whole value of a forward-looking tax plan. You are entering essentially uncharted territory into retirement, and your forward-looking tax plan is going to be the map that you need. Okay, but let's go into the question at hand. Does it make sense to convert all of your tax-deferred accounts in retirement? Well, again, let's step back for a second and remember, the only reason conversions make sense, the only time conversions make sense, is if the tax rate that you are converting at today is lower than the tax rate that you will see later on in retirement. So for instance, if you're converting today $1 at the 22% marginal tax rate, to avoid that same dollar being taxed at 25%, you have now captured a tax arbitrage. You have captured the upside of conversions. You have essentially saved 3% on taxes moving forward into the future. And so it's very simple to know when conversions make sense and when conversions don't make sense. Now, the more difficult part is calculating what your tax rate is today versus your tax rate into the future. But again, remember, this is the only time conversions make sense. This will be a theme as we go through this video, but invariably when I'm talking through tax planning with retirees, we get additional questions that kind of muddy the waters, if you will. For instance, what happens if Congress raises taxes? Should I be converting all of my accounts? Because again, we're in a national debt situation that the government is eventually going to have to deal with. And if they raise taxes down the line, won't it be better if I have all of my money in a Roth IRA versus in a tax-deferred account? And yes, in theory that's the case, but it depends on how much Congress is going to raise taxes. Question number 2 I often receive, and this is specifically from DIY investors. Obviously, as we talk through all of the tax planning hurdles that you'll face in retirement, from Medicare premium increases to potentially losing an ACA subsidy early in retirement, to potentially being subject to the net investment income tax, an extra 3.8% long-term capital gains tax. All of these different complexities start stacking on to each other in retirement. And if I convert all of my tax-deferred accounts, doesn't that just make everything more simple? Doesn't it make it so I don't have to be weighing all of these, again, potentially complicated topics here? And the answer is yes, but again, what is the goal in retirement? Is the goal to make planning simplistic, or is the goal to end up with the most after-tax wealth throughout your retirement? Depending on your answers to each of those questions, you will have a different Roth conversion strategy. And then also, won't converting all of my tax-deferred assets, won't that make some of my other assets that much more valuable? For instance, Social Security's taxability is determined by how much other taxable income you have. So if I don't have any other taxable income because my tax-deferred accounts are wiped out to zero, won't my Social Security benefit be tax-free or mostly untaxed? And again, the answer is yes, but what tax rates are you paying in order to get there? And so we'll start to talk through some of these additional questions towards the end, but for most people, trying to convert all of your tax-deferred accounts down to zero won't make sense, okay? And when I say most people, what I'm generally talking about are people that have Social Security as a main income stream, and then they have their retirement assets outside of that. So they have essentially two different assets that they can turn into income streams, Social Security and their retirement assets. And for this group of people, trying to convert all of your tax-deferred accounts generally doesn't make sense. And the reason being is because we have a marginally increasing tax system. So when you're taxed, let's say at the 22% bracket, you are first taxed at 0% underneath the standard deduction. For 2022, the standard deduction for a married couple is $25,900, meaning the first $25,900 of taxable income that you have is tax-free. It's at a 0% tax rate on a federal basis. From there, you fill in the next $20,500, and that's taxed at 10%. From there, you're taxed at 12%, and only those dollars above $83,551, before dollars go above $178,150, only those dollars are taxed at 22%. And so when we're thinking about trying to convert all of our tax-deferred accounts, it generally doesn't make as much sense for most retirees. For instance, if you're in a situation where you're trying to convert into the 22% bracket, in order to wipe out all of your tax-deferred accounts, okay, that doesn't make sense because in retirement, even once you're on Social Security, you're still going to be able to fill up smaller brackets, lower brackets, with those tax-deferred dollars. And so again, going back to that overarching idea that we talked about, it doesn't make sense to convert at 22% to avoid 0%, 10%, and 12%. That will make a Roth conversion hurt your situation, not help your situation. So does that mean that no one should be converting all of their tax-deferred balances? Well, again, the answer is no, because there are exceptions to this rule. Although for most people, converting all of their tax-deferred balances won't make sense, there is a subset of people that converting all of their IRA balances will make sense. And for the most part, these people are in a category where they already have forced income filling up some of those lower brackets. So on the screen right now, I have an example income graph for a couple. Both worked for the federal government, both have pensions that adjust to inflation. So as you can see on the graph here, this orange line is their income need through time. And as you can see, it's growing because of inflation. Now, we fill in their income with different bars here, and these yellow bars are essentially their pension income. These green bars are RMDs, these blue bars, these dark blue bars are Social Security, and these light blue bars are portfolio withdrawals. And as we can see by this person's situation, in the early part of retirement and in the later, larger half of their retirement, between pensions and Social Security, their income is completely met. Okay, they have their full income funded through these guaranteed income sources, these forced income sources. There's only a little bit of time here where they see that they have a slight portfolio withdrawal need here. But once RMDs start with their tax-deferred balances, they see that any RMD is pushing them up and above their income need, which is, again, tax inefficient. It means that they're paying taxes at higher brackets that they don't need. They don't need that given money. They're not taking it for income, and so they don't want to be paying taxes in those higher brackets. And so these are the type of situations where converting all tax-deferred accounts starts to make sense. And the reason for this is because their forced income, their pension income, is already filling up those lower brackets. It's already filling up the standard deduction. It's already filling up the 10, 12, and even portions of the 22% bracket. So if this couple can convert at lower rates to eliminate their tax-deferred balances, they can eliminate all of their tax-deferred balances and still have that make sense. And so towards the end, we'll talk about different classes of retirees that fit within this given category. But a big reason that conversions make sense during these times, especially when you have that forced income, is that forced income, again, is filling up lower brackets. Now, we know that when we're planning the previous brackets that we showed before, those just general federal marginal brackets, are fairly simple and pretty straightforward. But we have to translate those marginal brackets now into the Social Security tax torpedo graphs. The reason being is because once you add Social Security, the tax graphs become a little bit more complex, because as you're taking more taxable income, you're forcing more of your Social Security benefit into being taxed. We've covered in a few different videos what this tax torpedo is and how you can calculate it for your situation. I'll link to a few of those videos up in the right-hand corner up here. But this is a situation that we often see a lot with people that we're targeting to convert all of their tax-deferred balances. This is a single filer's tax torpedo. They have about $40,000 coming from Social Security in a given year. Okay, now let's say that they also have a pension that is going to deliver $25,000 of forced taxable income to them each and every year, which puts them about right here on this tax graph. Okay, well, we see that this theoretically or intuitively should be putting them in this 15% bracket here when we're looking back at normal brackets. But when we translate this to the Social Security tax torpedo, we notice that their marginal bracket is much higher. Again, the reason for this is as they're taking in income from other taxable sources, it's forcing more of their Social Security benefit into being taxed. Essentially, they're being double taxed here. $1 from their IRAs might cause $1.85 to being taxed here. So we'll see an 85% jump in marginal brackets here. And so their actual tax bracket here is 27.75%. Notice there's a little bit more income that they could take here before entering the worst part of this tax torpedo marginal bracket here, which is 46.25%. Now, again, I would note that this is after the Tax Cuts and Jobs Act here. But we see, again, this person, if they have any additional dollars that they're pulling from tax-deferred accounts, they are in some pretty high marginal brackets here. They can likely convert earlier in retirement at marginal rates lower than 27.75% and certainly lower than 46.25%. So this person is in a situation, again, where they likely want to eliminate all of their tax-deferred accounts if they can do so at rates lower than 46.25% and 27.75%. Now, there are a lot of questions you should be asking yourself to find out if you fit into one of those given categories where you should be converting all of your tax-deferred accounts. The big question that everyone, regardless of what situation they're in, they need to look at: what is my marginal rate right now versus what is the future marginal rate that I am trying to avoid? Again, this is the whole question that determines whether a conversion makes sense today versus not making sense today. But then to determine if you're in one of those situations where you should be trying to eliminate all of your tax-deferred accounts, there's a few different questions that you need to be asking. Do I have forced income in my retirement that's filling up all of those lower brackets that tax-deferred accounts otherwise could be filling up? Meaning that, do you have pension income that is filling up those lower brackets? Okay, that you don't have a choice whether to take or not. Do you have annuity income in that same way that's filling up those lower brackets? Do you have large rental properties that are spitting out rental income that once again is filling up some of those lower brackets? Might you receive an inheritance in retirement where, let's say, you receive $1 million IRA that, again, according to the Secure Act, you now have 10 years to withdraw that $1 million from your situation? Well, again, in the same way that is forced income, that you might want to eliminate all of your tax-deferred accounts so that you can deal with the tax-deferred inheritances that you might receive. And again, going back to some of those previous questions that we had, for instance, a question that I'm receiving a lot is, aren't taxes going to go up in the future? Don't they have to go up into the future? And I believe the answer is yes. But the question is not, will taxes go up into the future? The question is, how much will taxes go up into the future? If we believe there is going to be a large tax raise going into the future, then yes, maybe converting a little bit more aggressively right now makes sense. Okay? But without knowing the how much, without having guesses on the how much, it's very difficult to try to translate taxes going up into the future as an additional reason that you should be converting today. So these are some questions that you should be pondering in your situation in order to answer the question, should I be converting all of my tax-deferred accounts down to zero? For some retirees, the answer is going to be a resounding no. You want to use those tax-deferred assets to fill up some lower brackets. For other retirees, you may want to be converting all of your tax-deferred accounts. If you can convert those at lower rates, then you will see moving forward. Hopefully this video was informational. Always remember that you don't need more money. You need a better plan. You need a better Roth conversion strategy to save on taxes, moving forward into the future. Hopefully you like this video. Leave any questions and comments you have below. Hit the like button if you found value out of this video. And don't forget to hit the subscribe button. We release content weekly. You'll be notified of all future content that we release. Thanks for watching and have a great rest of the day. We will see you in the next video.